Imagine it's November 21st, 2003. You're a 34-year-old office worker living in Seoul, South Korea. You have a small apartment in the Mapo district, a steady job at a mid-sized trading company, and a wallet that holds 4 different credit cards. Every morning you take the subway to work, buy coffee with a card, buy lunch with a card, and pay for almost everything else the same way. The government has been encouraging this for years, even offering tax breaks for card spending, and everyone around you does exactly the same thing. Each month, when the statements arrive, you do what millions of your neighbors do. You pay the minimum, or you take a cash advance from one card to make the payment on another, and you tell yourself you will sort it all out later. If you have ever wondered why paying the minimum on a credit card feels harmless but somehow the balance never shrinks, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before, in different countries, in different decades, and it always ends the same way. And if you find value in this kind of a historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Now back to Seoul. On this morning in November 2003, you walk to the cash machine to take an advance from your LG card, the card issued by the biggest credit card company in the country. And the machine says, no. LG card, drowning in unpaid balances, has run out of money and has suspended cash advances. The chain you have been living on, borrowing from one card to pay another, snaps in a single day. Within weeks, you are one of nearly 4 million South Koreans officially listed as credit delinquents. That was almost 8% of the entire population of the country. Not 8% of borrowers. 8% of everyone, including children. This video is about the single most profitable trick in the history of consumer banking. The minimum payment. That small, friendly number printed on your statement. The one that looks like a helping hand. History shows it is not a helping hand. It is a design. It was invented on purpose by specific people at a specific time to keep you in debt for as long as mathematically possible. Today we are going to trace that design through history. We will look at how it was built in America, how it detonated an entire country in Asia, and how it quietly bled millions of households dry during the 2008 financial crisis. By the end, you will understand why paying only the minimum is not a payment plan. It is a slow motion transfer of your future income to a bank, 1 month at a time. Before we go further, there is something important to understand. The minimum payment is not designed to pay off your debt. It is designed to prevent your debt from being paid off. Those sound similar. They are opposites. Here is the mechanism underneath it all. When you carry a balance on a credit card, interest is charged on that balance, usually every single day. Interest is simply the rent you pay for borrowed money. On modern credit cards, that rent is enormous, often above 20% per year. Now here is the key. A typical minimum payment is calculated as a small slice of your balance, often around 2%, or your interest and fees plus just 1% of what you actually owe. Read that again. 1% of the actual debt. That means when you pay the minimum, almost your entire payment goes to the rent, and only a sliver goes to the debt itself. Think of it like this. Debt at high interest is not a hole you're filling. It is a hole that digs itself. Every day, interest adds a little more dirt at the bottom. When you pay only the minimum, you're shoveling out dirt at almost exactly the speed it falls back in. You feel motion. You feel effort. You feel responsible. But the hole barely changes, and the bank, standing at the edge, gets paid for every shovelful. This is compound interest working against you. Compound interest simply means interest charged on top of interest, the way a snowball rolling downhill picks up snow and gets bigger the longer it rolls. When compounding works for you, in savings, it builds wealth quietly. When it works against you, in debt, it destroys wealth just as quietly. Same force, opposite direction. The minimum payment is the tool that keeps that force pointed at you for as long as possible. That is the secret key. Hold on to it, because every story you're about to hear is this one mechanism wearing a different costume. This brings us directly to the first part of this story, where the minimum payment came from. Because it did not evolve naturally, it was engineered. Go back to September 1958 in Fresno, California, in the United States. A Bank of America executive named Joseph Williams did something no bank had ever done. He mailed 60,000 ready-to-use credit cards, unrequested, to ordinary households in Fresno. This event became known as the Fresno Drop. People opened their mailboxes and found instant borrowing power they had never asked for. The experiment was chaos at first. Delinquency, which means people falling behind on payments, ran far above what the bank expected, with estimates suggesting more than 1 in 5 accounts went bad. Williams lost his job. But the bank noticed something remarkable in the wreckage. The customers who did not default, but also did not pay in full, the ones who carried a balance month after month and just kept paying interest, were astonishingly profitable. The industry had discovered its favorite customer, not the deadbeat who never pays, and not the responsible person who pays in full, but the person in the middle who pays slowly, forever. Then came two decisions that supercharged everything. In 1978, the United States Supreme Court ruled in a case called Omaha. In plain words, the court said a bank could charge whatever interest rate its home state allowed, no matter where the customer lived. 3 years later, in 1981, Citibank moved its credit card operations to South Dakota, a state that had just removed its interest rate caps at the invitation of its own governor. Other banks followed to South Dakota and Delaware. The ceiling on credit card interest rates in America effectively vanished. Rates that once would have been illegal in most states became standard. And now enters the architect. In the 1980s and 1990s, a consultant named Andrew Carr became one of the most influential minds in consumer credit. He later founded Providian, a company built almost entirely around lending to people who carried balances. Carr is widely credited with pushing the industry toward one specific innovation, dramatically lowering the minimum payment down toward 2% of the balance. Why would a bank want you to pay less? Because a lower minimum does two things at once. First, it makes the debt feel lighter, so people borrow more. A $5,000 balance sounds scary. A $100 monthly minimum sounds fine. Second, it stretches the debt across decades, and every extra month is another month of 20% rent. In a 2004 investigation by the American program Frontline, called The Secret History of the Credit Card, industry insiders described this openly. The business model was named in plain language. The sweet spot customer was the one who revolved, meaning carried debt indefinitely. Inside parts of the industry, customers who paid their balance in full each month were literally called deadbeats because they generated almost no profit. Run the numbers, and the design becomes visible. On a $5,000 balance at roughly 20% interest, paying only a 2% minimum, estimates suggest the payoff stretches across roughly 3 decades, and the total interest paid can exceed the original debt itself. 3 decades. A mortgage-length sentence for a balance that might represent 1 bad month, 1 car repair, 1 hospital visit. The rot was not on the surface of the statement. It was built into the beams. Ordinary people in the 1980s and 1990s were not being reckless. They were responding rationally to a number a bank had placed in front of them, a number specifically calculated to be small enough to seem safe and large enough to never set them free. This leads to the second part of this story. Because what happens when this design is not just adopted by banks, but promoted by an entire government at once? Here is something I want you to think about before we go further. If a bank knows that the minimum payment will keep you in debt for 30 years and prints it on your statement anyway as the suggested amount, who is that number actually written for? You or their shareholders? Drop your answer in the comments, seriously, because what I am about to show you next is the part of this story that most people never hear, and it changes everything. Return to South Korea. In 1997, the Asian financial crisis devastated the country. The economy contracted, companies collapsed, and the government needed people to spend money again, fast. So, beginning around 1999, the government of President Kim Dae-jung did something extraordinary. It actively pushed credit cards onto the population. Tax deductions were offered for card spending. There was even a receipt lottery, where credit card receipts doubled as lottery tickets, so every swipe was a chance to win money. Card companies, backed by huge industrial conglomerates like LG and Samsung, flooded the streets. Salesmen set up the tables outside subway stations and universities, handing cards to students and young workers with almost no income checks. It worked, in the most dangerous sense of the word. Credit card spending exploded from roughly 60 trillion won in the late 1990s to over 600 trillion won by 2002, a roughly tenfold increase in about 4 years. By the end of 2002, there were over 100 million credit cards in circulation in a country of under 48 million people. Around 4 cards. And here is the detail that should make your skin crawl. A majority of card usage was not shopping. It was cash advances, people pulling borrowed cash off one card, very often to make the minimum payments on another. The entire system had become a circle of people paying minimums with borrowed money, a merry-go-round that only kept spinning as long as new credit kept arriving. Then the music slowed. Through 2002 and 2003, regulators tightened rules and card companies, seeing losses rise, cut credit limits. For a person juggling 4 cards, a cut limit on card number 1 meant the minimum on card number 2 could not be paid. Each missed payment triggered penalty rates and fees, making the next minimum even larger. The circle reversed direction. By late 2003, LG Card, the largest issuer in the nation, was collapsing under unpaid balances and had to suspend cash advances. The exact moment our office worker from the opening stood at that machine. LG Card required a rescue organized by creditors in the state in early 2004 to avoid a collapse that threatened the whole financial system. The human toll was staggering. By the end of 2003, roughly 3.7 million South Koreans were registered as credit delinquents, blacklisted from normal financial life. That was close to 1 in 10 adults. Suicides linked to debt made national headlines. Families hid from collectors. An entire generation of young Koreans began adulthood already underwater. And notice the mechanism. Almost none of these people took out one giant reckless loan. They made small purchases, paid small minimums, filled gaps with cash advances, and let compounding do the rest. The minimum payment did not look like a trap in Seoul in 2001. It looked like citizenship. The government endorsed it. The banks celebrated it. The trap was not hidden in the shadows. It was printed on every statement in a friendly font. And it was the smallest number on the page. Now here is where it gets interesting. Because you might think, surely, after Korea, the world understood the danger. Look at what happened next in the richest country on earth. In the years leading up to 2008, American households were carrying more revolving debt than at any point in history. Revolving debt simply means debt that rolls over month to month instead of being paid off, exactly what a minimum payment produces. Interestingly, in 2003 and again in 2005, American regulators had grown so alarmed by 2% minimums, sometimes structured so poorly that balances could actually grow even while people paid on time, a condition called negative amortization, which means your payment is smaller than your interest, so your debt rises as you pay, that they pushed banks to raise minimums to at least cover interest and fees plus 1% of principal. Major issuers roughly doubled minimums from around 2% to around 4%. Think about what that reveals. The payments had been set so low that the government had to force banks to charge people more per month, just so the debts would ever end. Then came the crash. In 2008 and 2009, unemployment in the United States surged toward 10%. Millions of households that had been surviving on minimum payments, balancing groceries and gas on plastic while wages stagnated, hit the wall the same way Korean households had 5 years earlier. When income drops, the minimum payment is the first domino. Miss one, and penalty interest rates, then often approaching 30%, kicked in. Balances that were barely shrinking began actively growing. Credit card charge-offs, which means debt the banks gave up on collecting because the borrower simply could not pay, climbed to a peak of roughly 10.5% of all balances in 2010, the highest ever recorded. Behind that dry statistic were tens of millions of kitchen table conversations, collection calls, and ruined credit histories. And then, in 2009, something quietly revolutionary happened. The United States passed the Card Act. Among its rules was one that sounds almost boring. Every credit card statement now had to include a small box showing how long it would take to pay off the balance, making only minimum payments, and what it would cost. For the first time, the math was printed where people could see it. Millions of Americans looked at a statement for a few $1,000s of debt and read in black and white payoff time, over 20 years. Researchers later studied the law's effects. One major academic study by economists including Sumit Agarwal and Neil Mahoney estimated the Card Act's rules saved American consumers roughly $11.9 billion per year, largely by limiting surprise fees and repricing tricks. Nearly $12 billion every year that had previously been flowing from ordinary households to card issuers through mechanisms most customers never understood. That number is the price tag of the fog. The moment the fog was partially lifted, $12 billion a year stopped moving. It tells you exactly how much the confusion itself was worth. The lesson of 2008 is not that Americans were foolish. It is that the minimum payment converts a temporary emergency into a permanent condition. A layoff should be a 6-month problem. Routed through minimum payments at penalty interest, history shows it became a 15-year problem for millions of families. The floor gave way in 2008, but the cracks had been spreading statement by statement, minimum by minimum for a decade. Most people will never know what you now know. Most people will keep looking at that small number on their statement and believing it is a suggestion made in their interest. If you're still here, you are not most people. Hit subscribe. Because this next section is the part this channel was made for, the part they never put in textbooks. Now look at all three stories together. America from 1958 to the 1990s, where the minimum payment was deliberately engineered downward to maximize the lifetime of a debt. South Korea from 1999 to 2003, where an entire nation was placed on the minimum payment treadmill at once, and the treadmill collapsed in 4 years. The United States again in 2008, where minimum payments disguised a decade of household fragility until a recession exposed all of it at once. Different countries, different decades, different cultures. The same mechanism every single time. A small required payment that feels like relief but functions as a leash. Interest that compounds daily while payments crawl monthly. A business model that profits most when you make progress most slowly. And a moment of reckoning, personal or national, when income dips and the arithmetic that was always there suddenly becomes visible. Here is the part you cannot unsee. In every case, the minimum payment worked exactly as designed. It was not a system failure. Korea's card companies made fortunes right up until 2003. American issuers earned record profits through the 1990s and 2000s. The crash, the delinquency, the blacklists, those were not the system breaking. They were the system completing its cycle. The minimum payment is not a bridge over the river of debt. It is a toll booth built in the middle of the river, and the toll is collected every month you fail to reach the other side. Once you see the minimum payment as a product, something manufactured, tested, and priced to extract the maximum interest from your lifetime, you can never again see it as a favor. At this point, the pattern becomes impossible to ignore. And this is where history gets uncomfortable. Because the pattern does not hurt everyone equally. It never has. Who gets hurt the most? History gives a consistent answer. First, the young. In Korea, university students handed cards at subway stations began their working lives blacklisted. In America, students and young workers with thin incomes were prime targets for low, minimum, high-rate cards because they had decades of interest payments ahead of them. Second, the working poor and the paycheck, whom the card is not a convenience but a shock absorber, covering the car repair, the medical bill, the gap between rent and payday. These are the households most likely to carry balances, and estimates suggest that even today, nearly half of American cardholders carry a balance month to month, paying rent on old groceries and old emergencies at rates above 20%. Third, people hit by life events, divorce, illness, job loss. Research on American bankruptcies has repeatedly found that medical costs and income shocks, not luxury spending, sit behind an enormous share of consumer debt failure. The minimum payment takes these people's worst month and stretches it across their next 20 years. Now, who walks away fine? Also consistent. The banks, first and always. Revolving credit has been among the most profitable forms of lending in modern banking history, precisely because of the minimum payment structure. Even after the write-offs of 2003 in Korea and 2010 in America, issuers recovered and returned to record earnings within a few years. Second, and this is the bitter irony, the wealthy cardholders, people who pay their balance in full every month pay no interest at all. They collect rewards, points, and cash. Back, benefits funded substantially by the fees and interest paid by those who revolve. Economists have described this bluntly. The credit card system contains a quiet transfer from those who carry balances to those who do not, from the stressed to the comfortable, from the borrower at 22% to the customer flying on points. The person paying minimums is not just paying the bank. They are, in effect, sponsoring someone else's free flight. In every era we have examined, the dividing line was never intelligence and rarely income alone. It was whether a person's relationship with the card was full payment or minimum payment. On one side of that line, the card is a tool. On the other side, the person is the tool. The question is not whether this pattern will repeat. History has already answered that. It is repeated on at least 3 continents. The only question is which side of the arithmetic you are standing on, and whether you saw the line before it saw you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So, what did the survivors do? Not advice, just the historical record. And the record is remarkably consistent across Korea in 2003, America in 2010, and every debt spiral in between. Those who came through these periods intact largely shared 3 characteristics. First, they treated the minimum as a floor to ignore, not a target to hit. Households that paid meaningfully above the minimum, even modestly above it, collapsed their payoff timelines from decades to a few years, because every extra dollar attacked the principal, the actual debt, rather than the interest. The mathematics of compounding, so brutal in one direction, becomes an ally the instant payments outrun interest. Second, they understood their own numbers. After the Card Act forced payoff timelines onto statements, behavior measurably shifted for those who read them. The survivors were, in every era, the people who actually knew their interest rate, their real balance, and their real payoff date, while those who suffered most often could not name any of the 3. The fog was the enemy. Clarity was the shield. Third, they broke the borrowing circle early. In Korea, the families who escaped were the ones who stopped taking cash advances to service other cards at the first sign of strain, accepted the short-term pain, and shrank their lifestyle before the system shrank it for them. The ones who kept the merry-go-round spinning until it stopped on its own lost everything, including choices. History suggests the single most dangerous month in any debt spiral is the first month you borrow to make a minimum payment, because from that point, the debt is no longer financing your life. It is financing itself. The survivors recognized that moment. The casualties explained it away. Let us go back to Seoul, to that office worker standing at a dead cash machine in November 2003. We do not know one single person's exact fate, but we know the statistical fates that awaited people exactly like them. Some spent years on the delinquent registry, locked out of loans, apartments, even certain jobs. Some entered the government's debt workout programs that Korea was forced to create for millions of citizens. And some, the ones who acted early, cut their cards, took second jobs, and attacked principal instead of feeding minimums, emerged in a few hard years, bruised but free. The difference between those outcomes was rarely how much they earned. It was when they stopped believing the smallest number on the statement. Here is the final lesson, and it is the same lesson from Fresno in 1958, Seoul in 2003, and every American kitchen table in 2009. The minimum payment is the most successful piece of financial engineering ever aimed at ordinary people, precisely because it does not feel like a trap. It feels like kindness. It feels like breathing room. But history shows that breathing room, at 20% compounding interest, is simply the room in which your wealth quietly suffocates. Debt at high interest is not a fire that burns your house down in a night. It is a leak in the foundation, and the minimum payment is the sound of someone telling you the puddle is normal. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will glance at that small number next month and pay it without a second thought. But if one person in your life is standing on the wrong side of that arithmetic, share this with them, not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.